taxation in retirement isn't always about paying less. So
it sounds like dividends are a good idea, but I've heard the dividend tax credit can sometimes backfire, especially with OAS clawbacks. Could you explain?
Canada uses a progressive tax system, meaning the more you earn, the higher the percentage of tax you pay.
For non-registered investment accounts, what do retirees need to know?
I guess the first thing to understand is that hello and welcome to another episode of Your Retirement Planning Simplified. I am Joe Curry, and as always, my co-host Lindsay Wilson with me today. How are you, Lindsay?
I'm very well. And you, Joe?
I'm great, thanks.
So today's discussion is about your income tax, how your income is taxed in retirement. Because understanding how income is taxed in retirement is such a crucial part of planning for a secure future. So I'll be guiding today's conversation, but Joe will be filling in the required information. So, Joe, I'll let you lead off.
Sure, yeah. So, taxation in retirement isn't always about paying less. So I want to make sure in this episode we're understanding that it's about maximizing our tax income efficiency, right? So we want to make sure you're getting the most out of your retirement savings at the end of the day. So we're going to cover off some different types of retirement income and how they're taxed. And at the end, we'll talk about actually answer a listener question and talk about OAS clawbacks. And then whether it's our next episode or in a near future episode, we're going to go a little deeper more into strategies to reduce taxes and avoid common mistakes. So today's more about the taxation of income, and then the next one will be more about strategy.
That's great. So let's start with the basics of retirement taxation, and we'll start with the fundamentals. How does the tax system in Canada impact retirees differently compared to when they were working?
So I guess the first thing to understand is that Canada uses a progressive tax system. So meaning the more you earn, the higher the percentage of tax you pay. But in retirement, you're often drawing income from multiple sources, right? So that means managing your tax brackets becomes even more important. So when you're working, Lindsay, just to specify, is you often, especially if you're employed, you don't really have a lot of say, or there's not a lot of flexibility on managing your income sources, right? You get your paycheck, you pay your tax, and it is what it is. So in retirement, though, you may have some different buckets to pull on. So we want to make sure we're thinking about how are we doing that in a tax efficient way.
Mm-hmm. And there's and that's where concepts like marginal tax rate and average tax rate come in, right?
Yeah, exactly. So your marginal tax rate is the amount of tax you pay on the next dollar of income you earn, while the average tax rate is what you're paying overall. So I'll just go a little deeper on that. This is something I find people get really confused on. They think that in a lot of cases I hear, I don't want to work anymore because if I make more, I'm going to have to pay more taxes. It's not even worth it. So it's important to understand that the marginal tax rates are how do we think about this? I'm just going to do this on a very simple scale, I think, Lindsay. Let's say that every $10 of income you earn was in the next marginal rate. So if you earned, let's say on the first $10, you pay no tax. That's the first marginal bracket. And then on the next $10 from 10 to 20, you pay 10% tax. So what that means is that just on the money you earn between 10 and 20, that's what you're paying that 10% tax on. It does not go back to $1. And then so if we went from 20 to 30, assuming that was another tax bracket at 20%, it would just be the money you earned over $20 up to 30 that would be at that 20%. So when you make more money, you're not getting taxed at that new percentage, that new marginal rate, all the way back to $1. So that's the marginal tax rates, how it works. And then when we talk about effective or average tax rate, what we mean is if you look at how much tax you paid in each of those brackets, take the total tax you paid in a year and divided it by your income, that'll give you your average tax. Okay. Does that make sense, Lindsay, as I'm explaining that?
I think so, yeah.
Okay. So that's something that I think is really important for people to understand, because I think it does affect the decision-making around trying to make more money. And then for retirees, knowing the difference helps you make better decisions about when and how to withdraw from different accounts, which is really important.
Mm-hmm. So Let's move on to the taxation of different retirement income sources. So we'll break it down by income source. First up, RRSPs and RRIFs. How are they taxed?
Okay. So RSPs and RRIFs, but they're tax deferred, meaning you don't pay any tax when contributing. So, and there's tax deduction too. So if you make $100,000 and let's say you put $20,000 into an RSP, then in that year, your net income for what you pay tax on is only $80,000. So that means you have $20,000 that you got it tax free, went into your RSP. While it's in there, you're not paying any tax on dividends, interest, capital gains. It's continually growing tax deferred. But when you go to take money out, the withdrawals are fully taxable as regular income. Once you turn 71, you must turn your RSP into a RRIF, Registered Retirement Income Fund. There's no difference in how you invest in an RSP or a RRIF. I mean, there could be if your goals have changed, your time horizon, but like you can do all the same things. The difference is RSPs are savings plans, registered retirement savings plans. They're meant to put money into, and the RRIF, you have to take a minimum out of each year. So once you move that money into a RRIF, you have to do it by 71. By 72, you have to start taking the minimum amount out. Now you can go to a RRIF earlier, Lindsay, but that's when you have to do it. And when you start taking those RRIF withdrawals, they're fully taxable, just like if you were taking withdrawals from your RSP. So it just goes into your income, just like if you were working and you got earned income. If you earned $100 at your job or you took $100 out of your RSP, both of them are fully taxable income.
Mm-hmm. So it's important to think about when and how to withdraw from an RSP to avoid big tax hits, correct?
Yeah. So one strategy could be to start drawing on your RSPs earlier in retirement to spread that taxable income out over more years. So now, first of all, this is not the right strategy for everybody. We'll talk about this more in the next episode, but none of these strategies we talk about are for any one person. There's just different situations that call for a different strategy. So really high level, a lot of people will just defer as long as they can. Then 71, they have to make the switch. Like we talked about, 72, they have to start taking the money out. The problem for some people is that could push them into a higher tax bracket, could mean old age security clawback. So there's a few things that could go wrong by doing that actually leads to more lifetime tax. Whereas if we started taking money earlier from the RSPs, we could have potentially got that money out of there in a lower tax bracket.
Right. And what about TFSAs and how do they compare?
Sure. So you put after-tax money into your tax-free savings account. So I gave that example with the RRSP where you got that deduction off your income and you didn't pay tax on whatever went into the RSP. With your TFSA, if you earn money, you have to pay tax on all of it before you can put anything in there. So you earn $100,000, you pay all your tax on $100,000, but whatever you don't spend, you want to save or invest, you can take that and put it into a tax-free savings account. So there's no tax paid, just like in the RSP, on dividends, interest, capital gains, any kind of growth within that account. And where it's different than the RSP on the other end is that when you take it out of there, you're not paying any tax. So it's totally tax-free. So that's the tax-free savings accounts. And so it works really good, Lindsay, for flexible spending, right? So for example, we need to take a lump sum out. If we take it out of an RSP, we might have a big tax hit where if something comes up where we need that lump sum and we're already at the top of our tax bracket, we don't want to take any more from RSP. If we have money in our TFSA, it's a great place to provide that flexibility.
And for non-registered investment accounts, what do retirees need to know?
Okay, so your non-registered investment accounts are, just like a checking account or a savings account in the sense that there's nothing special about them from a tax standpoint. So you pay tax on those accounts depending on the type of income you're receiving. So interest income, for example, is fully taxable. So if you earn $1 of interest income, you have $1 of income on your tax return that you have to pay tax on. Now, dividends, so if you have dividend stocks, like bank stocks here in Canada, for example, are typically paying dividends, you receive a tax credit, making them more tax efficient. But there's also a key distinction, which I won't dive into too much here, between eligible and ineligible dividends. So for most people, when it comes to their retirement income planning, they're going to have eligible dividends. So those are dividends coming from larger Canadian corporations, and you're receiving the higher dividend tax credit. They're a little more tax efficient. Now, ineligible dividends are going to be applicable basically for business owners where they're taking income out of their corporation. So maybe they saved in their corporation instead of an RSP, or alongside their RSP when they take money out of there. There's not going to be quite as tax favorable. So there is a little bit of a difference there. I'm not going to go take a deep dive into that. I just want to make sure I'm pointing it out. If you hear eligible versus ineligible, it's usually a larger company versus a smaller company. And then there's capital gains, which at this point, and we've talked about the changes in capital gains taxes a couple times on the show, but right now, capital gains are still only 50% taxable. Meaning, if you had a stock, for example, and you paid $100 for it, and it grew to $200, now you have a $100 capital gain. Only 50% of that. So in that case, $100 capital gain, if you sell that entire investment, you get $200 back, and $50, half of the gain, will go into your income for taxation purposes. So those are the three main types of income that you would see inside a non-registered account.
So it sounds like dividends are a good idea, but I've heard the dividend tax credit can sometimes backfire, especially with OAS clawbacks. So could you explain?
Sure. So while the dividend tax credit reduces taxes payable, it also grosses up the dividend. So the amount of income you're getting from the dividend when calculating your total income. So basically what happens is if you have $100 of a dividend, for example, and then what you get a gross up, we call it. So on the eligible dividend, it's 38%. So instead of $100 of income going to your taxable income, it would be $138 of income. So in that scenario, now that could affect income tested benefits like old age security, Lindsay, because it might bump you to another tax bracket. It might bump you into the old age security clawback threshold. It could affect your age credit. So there's some negative impacts of that. Now, you do get money back through the tax credit on the other side of this, but the way dividends work is that grossed up amount goes into your net income. And then after your net income has been calculated, then tax credits are applied. And then so you get some money back in taxes, for example. But again, those income tested benefits will be potentially affected.
Mm-hmm. Mm-hmm. So someone relying heavily on dividends might need to be mindful of how it affects their overall taxable income.
Yeah, so it's a great example of why tax planning in retirement isn't just about lowering taxes, but it's about strategically managing income sources to avoid unintended consequences such as that.
Yeah, and how do government benefits like CPP, Canada Pension Plan, and Old Age Security fit in?
Yeah, so CPP is fully taxable as income. So you receive $1,000 of CPP, it's $1,000 into your income to pay tax on. Old age security is also fully taxable, but there's the potential, which we've already talked about today, we've talked about on many episodes, for old age security getting clawed back. There's no guarantee you're going to get it. If your income is over a certain threshold, it's like paying an extra tax. So I can't remember the number off the top of my head. I think it's around $93,000 this year is where the old age security clawback threshold begins. So for every dollar of income you make over that threshold, 15 cents of your OAS is basically drawn back. We'll call it like a tax, or the clawback, right? So there's the potential you pay additional tax depending on where your income's at, but basically old age security is fully taxable as income, just like CPP.
Mm-hmm. And so that brings us to employer pensions and the pension income tax credit. What do retirees need to know about this?
Yeah, so employer pensions, whether this is money coming from a defined benefit pension or money that was in a defined contribution, which is maybe now in a LIF, something like that. So it is fully taxable. Like that is income, just like taking money out of your RSP or earning money. But one of the advantages of pension income is that you can do pension income splitting to reduce taxes. So if you have a spouse, and we actually did an episode on this a long time ago, Lindsay, where if you're single, unfortunately, you don't get some of these benefits, right? But if you do have a spouse, you can share up to 50% of that pension income with your spouse, so that if you're in a higher tax bracket, that could lower your income. It will bring theirs up, but overall, that splitting could bring your household tax down, right? The other thing is that if you have pension income, you get a pension income tax credit. So if you get the tax credit, basically what that means is you get, roughly $2,000 out of your pension or out of your RRIF if you're over 65, tax-free. So there's some advantages to pension income.
Mm-hmm. So would there be a reason to convert a portion of an RRSP into a RRIF, even if someone isn't planning to start full withdrawals?
Yeah. So to continue on what I was just talking about, that pension income tax credit, basically, you may not want to have anything coming out of your RSP. You're planning on delaying. But once you're 65, if you move your RSP to a RRIF, anything that comes out of the RRIF is considered pension income. So if you were to take a withdrawal from your RSP, it's not considered pension income. So for that reason, it could make sense to just move some money, even if it's just a little bit, to a RRIF and take that withdrawal to get a little bit of basically tax-free money out of the RRIF. And alternatively, depending on the tax brackets of your spouse or your spouse, like it could also make sense to do it at 65 as well, because like we just talked about, that pension income, you can split some of it. So it might make sense, even if you don't need the income, to do that, even if it's on a small scale, to get some money out of the lower tax bracket, that maybe you just turn around and reinvest in your tax-free savings account or non-registered investment. So there's definitely times where it would make sense to do that.
Mm-hmm. So Joel, what do you think are the biggest takeaways from today's discussion?
So kind of as I led off in the episode, is that tax planning isn't really just about reducing taxes that we pay today, but it's about maximizing income efficiency, right? We're looking to reduce your lifetime tax bill and keep as much money as possible in your pocket and make sure your savings last. That's really what we're trying to do. So it's not just about what happened this year and how do we reduce taxes today.
Mm-hmm. And in a future episode, as you also mentioned, we'll go even deeper into tax strategies and common mistakes retirees make.
That's right. So we've already got that one mapped out. So looking forward to getting through that, providing some tangible strategies. So in the meantime, you can subscribe, share this with someone else who's doing some retirement planning, and then hopefully we'll see you back here for the next episode.